Greetings class and welcome back. This is Accounting 201. In this video I'm going to finish the lecture for Chapter 5. This is the second half of that video. I'm backing up just a bit so we can kind of go over what we were talking about last time. In the first part of this lecture we were talking about valuing inventory, and we have specific identification, FIFO, LIFO, and weighted average. Specific identification is going to be for large items, okay? We're not going to use this with a high volume retailer. This is going to be with somebody who has large ticket identifiable items that have individual serial numbers or individual ID numbers on them, like an auto dealer, maybe an appliance dealer perhaps, or perhaps even a jeweler. If you were in a jewelry store, you would have large ticket valuable items. Now, FIFO and LIFO and weighted average can be used by high volume retailers, and they are. The difference is what emphasis are you placing and where. If you're using FIFO, you're going to approximate the cost that you're dealing with in ending inventory. If you're using LIFO, you're going to try and attempt to identify that cost in cost of goods sold. Weighted average comes out in between the two. We'll get into that a little more later. But I want to look at this cost flow of inventory. This is a really good slide because it says, it shows you here the actual formula. Beginning inventory plus net purchases equals merchandise available for sale. And ending inventory plus cost of goods sold equals ending merchandise, or merchandise available for sale. But what I want to do is look at this like a cost of goods sold formula. So we have beginning inventory here plus purchases. That's goods available for sale. And then we subtract out ending inventory. And that gives us cost of goods sold, okay? So really, if you look at this slide, you can think of it in two ways. You can see this as an equation where these equal each other, or you can think about this as a template for this calculation. And quite honestly, we're going to use this calculation a lot, and I would highly recommend that you become very familiar with it. All right, when we look at inventory costing, we want to look at how it impacts the balance sheet, because the ending inventory is going to go on the balance sheet. If we're focused on the ending inventory and the balance sheet, we could use one method of valuation. If we focus on cost of goods sold in the income statement, we could use another. But here's the most important point. You don't have to match the physical flow of goods with the method that you choose to follow. Okay, I'm not going to go through these specific illustrations because we did that in the problem demonstration video. So we're not going to do that here. But what I am going to do is to take a look at these different costing methods. Now, I mentioned this a moment ago, but if we're using a first in, first out method, we're going to be more interested in the value of ending inventory and having it approximate current cost. Now, first in, first out will approximate most retailers' flow of goods, but it doesn't necessarily reflect the emphasis that the business wants to have. But if you're in like a grocery store or something like that, it's clear that you're going to sell the things you receive first, and then the newer things last. For a last in, first out valuation, what this does is it places the emphasis on the cost of goods sold in the income statement. So here we're interested in identifying or approximating the cost or current cost in cost of goods sold. The argument would be if we use first in, first out, the cost of goods sold may be understated, especially if you're in an era of increasing costs. And because of that, some retailers want to use the last in, first out method to approximate their costs and actually reduce net income on the income statement. Now, the thing is, weighted average comes right in between the middle of these two, and it smooths out any price changes you might have. And again, if you're going to use that method, it's just going to be kind of a middle-of-the-road approach. Here's an example of the different costing methods and how they impact the net income that we're talking about, gross profit and net income. Well, gross profit, but it will flow through to net income. So you see the specific identification and the way it values cost of goods sold here. Now, this is not predictable because it depends on the items you have if you're doing a specific identification. But with FIFO, if you're in a period of time where costs are increasing, the cost of goods sold for FIFO will be lower than it is for LIFO. And it does show that here, see? So if you're in an era or a time period where the costs are increasing for your inventory, FIFO gives you a lower cost of goods sold. Weighted average comes in right between those two. So some folks look at this and they go, okay, well, I want to avoid the taxation, so I'm going to go with this LIFO method. And that's perfectly reasonable. You can do that. But if you choose LIFO for tax purposes, you have to use it for financial reporting as well. So I'll give you a great example. Marsh Supermarkets is no longer in business, but before they went out of business, they basically, like any supermarket, operated on a first in, first out. However, their financial statements were prepared on a LIFO method because they sought to reduce the taxation that they were paying. Okay? Now, the next thing we want to talk about is the lower of cost or market. And what this reflects is the conservatism principle in accounting. We do not want to overstate anything. In fact, we'd rather understate it if possible. But what we want to do is say, okay, we look at the value of our inventory and compare it to the market. And if the market is lower, then we adjust our inventory value to reflect that. So we can do this one of three ways. We can do it with each individual item here. We can do it to categories of assets here, or we can do it to the whole inventory here. When we talk about categories of assets, I'm talking about like equipment, buildings, and so on. Or, well, those are assets. But if we're talking about inventory, it may be different kinds of products as well. So here's an example of lower cost or market. You have this retailer that has two inventory items, a Roadster, I assume these are vehicles, and a Sprint. They have 20 units of each. They have 20 units of this. Okay, well, maybe not. It's a vehicle. I don't know. 20 units at $8,500 cost, but the market is $7,000. The cost here is $5,000, but the market value is $6,000. See, the cost is $1,500 per item higher than what the market says. The total cost that they have in inventory here is $170,000. The total market will be $140,000. What this means is you need to adjust the value of the inventory for this item. If the market value will only bring $140,000, then these items need to be reduced in value to $140,000. Now look at the Sprint model. If we look at this, we have $50,000 in total for this compared to $60,000 in the market, meaning that we're going to value this at the cost that we have, which is 50,000. Now, because this cost here, this market is lower than, because the market right here is lower than what we have in cost, we need to make this adjusting entry. And this adjusting entry will be to reduce the value of inventory. So we're reducing inventory value, but we're also increasing cost of goods sold. So we need to acknowledge that that this adjustment is needed to write down inventory and increase cost of goods sold. Okay. When we look at the impact of inventory on current and future statements, here are some examples. If we understate ending inventory, cost of goods sold is overstated in the first year, and net income is understated. In year 2, it will reverse itself. You see that? Likewise, if we overstate inventory, it will the cost of goods sold will be understated, and income will be overstated, but the second year that will reverse itself. It happens because we're always moving ending inventory value forward. See this? We have the ending inventory here from the first year, and we understated ending inventory there. We move it in here. What this naturally does then is create an overstated value in the second year. And then in the third year, again, this will come through, and it basically corrects itself over a period of time. Now, that doesn't mean we don't need to be aware of it. We do, but I'm just showing you that after a couple of years, you wind up self-correcting. Okay, a couple of final things to think about with inventory are the calculation of inventory turnover. This is an analysis tool that tells us how often we sell our inventory. So how often are we selling our inventory? Ideally, if you're in a retail business, you would like to be selling your inventory out each month, or turning it over each month. Depends on what kind of business you're in. So what you're going to do is take the cost of goods sold divided by average inventory, which is the beginning inventory plus ending inventory divided by 2. This ending inventory will tell you how long it takes you to sell your inventory. Another valuable tool when looking at inventory as a ratio is the days sales in ending inventory, or in inventory. So you're going to take the ending inventory divided by cost of goods sold times 365. What this tells you is what kind of a cushion do you have in ending inventory? How long will it last? And this is going to be reflective of the inventory turnover as well. So here's a good example. Costco and Walmart inventory turnover and days sales and inventory are shown below. Costco is selling out its inventory 11.9 times in the current year. I think this Walmart number is 8.3 times, not 8.3 days. It might be, I don't know. But anyway, typically when you look at inventory turnover, it's 11.9 times a year. That means you're selling it once a month. And the days sales in inventory means you have 32.1 days in sales, not times. So this would be days. Likewise here, this makes sense if Walmart's inventory is turning over 8.3 times a year, then they would have 43.5 days of sales in inventory. Okay, so that really does wrap up the Chapter 5 lecture videos. And again, there will be another problem video and to follow this. And if you have any questions, feel free to let me know. I'll be glad to check in with you.